In the world of finance, understanding the true worth of an asset is paramount. This is where valuation comes into play. It is the art and science of determining what something is worth. While basic valuation methods provide a starting point, sophisticated investors need advanced techniques to navigate the complexities of financial markets. This essay will serve as your guide to understanding and applying these advanced techniques, empowering you to make more informed investment decisions. We will delve into the intricacies of discounted cash flow, or DCF analysis, a cornerstone of fundamental valuation. You will learn how to calculate and interpret key metrics like net present value, or NPV, internal rate of return, or IRR, and more. But our journey doesn't stop there. We will also explore the fascinating realm of real options, hidden sources of value that traditional valuation methods often overlook. Get ready to expand your financial toolbox with powerful concepts like option pricing theory. We'll cover various types of options, from the familiar calls and puts to the more exotic varieties. By the end of this essay, you'll have a solid understanding of how to value real options and incorporate them into your investment analysis. So, fasten your seatbelts and get ready to unlock the secrets of advanced financial valuation. Discounted cash flow, or DCF analysis, is a fundamental valuation technique that estimates the value of an investment based on its expected future cash flows. The core principle of DCF is the time value of money, which states that $1 today is worth more than $1 tomorrow. This is because you can invest $1 today and earn a return on it. DCF analysis takes this concept into account by discounting future cash flows back to their present value using a discount rate. The discount rate represents the opportunity cost of investing in a particular asset, or the return an investor could expect from investing in an asset with a similar risk profile. There are two main DCF methods: net present value, or NPV, and internal rate of return, or IRR. We will explore both methods in detail, along with some variations, to equip you with a comprehensive understanding of DCF analysis. By mastering these techniques, you will be well equipped to assess the intrinsic value of investments and make informed decisions. Net present value, or NPV, is a widely used DCF method that calculates the present value of an investment's expected future cash flows, minus the initial investment. This method is crucial for investors and financial analysts, as it helps in determining the profitability and feasibility of an investment. In simpler terms, NPV tells you how much value an investment is expected to create in today's dollars. It translates future earnings into present-day terms, making it easier to compare different investment opportunities. A positive NPV indicates that the investment is expected to be profitable, meaning the projected earnings exceed the initial costs and the discount rate applied, while a negative NPV suggests that it is likely to result in a loss. This means the investment would not cover its costs and the expected return would be less than the discount rate. Here's how to calculate NPV. It's a step-by-step process that requires careful estimation and calculation. First, estimate future cash flows. This involves projecting the cash inflows and outflows associated with the investment over a specific period. These projections should be as accurate as possible to ensure a reliable NPV calculation. This involves projecting the cash inflows and outflows associated with the investment over a specific period. These projections should be based on realistic assumptions and thorough market analysis. Next, determine the discount rate. This rate reflects the riskiness of the investment and the opportunity cost of capital. It is essentially the rate of return that could be earned on an investment of similar risk. This rate reflects the riskiness of the investment and the opportunity cost of capital. The discount rate is crucial as it adjusts future cash flows to reflect the time value of money. Then, discount future cash flows. This step involves applying the discount rate to each projected cash flow to bring it to its present value. Divide each year's cash flow by 1 plus the discount rate raised to the power of the year. This calculation adjusts the future cash flows to their present value, making them comparable to the initial investment. This brings all future cash flows to their present value. By doing this, you can accurately assess the value of future earnings in today's terms. After that, sum the discounted cash flows. This step involves adding up all the present values of the projected cash flows. Add up all the discounted cash flows. This total represents the present value of all future earnings from the investment. Finally, subtract the initial investment. This step determines the net value created by the investment. Deduct the initial investment from the sum of discounted cash flows. The result is the net present value, which indicates the profitability of the investment. For example, imagine you're considering investing in a small business for $100,000. This initial investment is the amount you will subtract from the total present value of future cash flows. You project that the business will generate $30,000 in cash flow each year for the next 5 years. These projections are based on market research and business performance expectations. Assuming a discount rate of 10%, the NPV would be calculated as follows. This rate reflects the risk and opportunity cost associated with the investment. Year 1, $30,000 divided by 1.10 raised to the power of 1 equals $27,273. This calculation adjusts the first year's cash flow to its present value. Year 2, $30,000 divided by 1.10 raised to the power of 2 equals $24,793. Similarly, this adjusts the second year's cash flow. Year 3, $30,000 divided by 1.10 raised to the power of 3 equals $22,539. This process continues for each subsequent year. Year 4, $30,000 divided by 1.10 raised to the power of 4 equals $20,490. Each year's cash flow is discounted to reflect its present value. Year 5, $30,000 divided by 1.10 raised to the power of 5 equals $18,627. The final year's cash flow is also adjusted to its present value. The total present value of cash flows is $113,722. This sum represents the value of all future cash flows in today's terms. So, NPV equals $113,722 minus $100,000, which equals $13,722. This positive NPV indicates a profitable investment. In this example, the NPV is positive, indicating that the investment is expected to generate a return greater than the 10% discount rate. This means the investment is likely to be profitable and worth pursuing. Section 4, Internal Rate of Return, or IRR. A familiar concept with a twist. The internal rate of return, or IRR, is another widely used discounted cash flow method that calculates the discount rate at which the net present value of an investment equals 0. This means that the present value of the investment's cash inflows equals the present value of its cash outflows. In simpler terms, the IRR represents the effective rate of return that an investment is expected to yield. It is essentially the rate at which an investor can expect to break even on their investment. To understand IRR, think of it as the break-even discount rate. It is the rate at which the net present value of all cash flows, both incoming and outgoing, from a particular investment is 0. If the IRR is higher than the required rate of return, the investment is considered attractive. This is because the investment is expected to generate a return that exceeds the minimum return required by the investor. Conversely, if the IRR is lower than the required rate of return, the investment is generally not considered worthwhile. This indicates that the investment would not meet the investor's minimum return expectations. Calculating IRR typically involves using a financial calculator or spreadsheet software, as the formula can be complex to solve manually. The process requires iterative calculations to find the rate that sets the net present value to 0. Now let's revisit our previous example of the small business investment. This will help us see how IRR is applied in a real-world scenario. Recall that the initial investment was $100,000 and the expected annual cash flow was $30,000 for 5 years. These cash flows are crucial in determining the IRR. Using a financial calculator or spreadsheet software, we find that the IRR of this investment is approximately 15.24%. This calculation takes into account the timing and amount of each cash flow. This IRR of 15.24% is higher than the 10% discount rate we used earlier, indicating that the investment is expected to generate a return that exceeds the required rate of return. This makes the investment more appealing. Therefore, based on the IRR rule, this investment would be considered attractive. It suggests that the investment is likely to be profitable and meet or exceed the investor's expectations. Section 5. Modified Internal Rate of Return, or MIR, Adjusted Present Value, or APV, and Profitability Index, or PI, specialized tools for specific scenarios. While NPV and IRR are the most common discounted cash flow methods, there are other specialized techniques used in specific situations. First, the Modified Internal Rate of Return, or MIR. MIR addresses a limitation of IRR by assuming that cash flows are reinvested at the cost of capital rather than the project's own IRR. This provides a more realistic assessment of an investment's profitability, especially when dealing with unconventional cash flow patterns. MR is particularly useful in projects where the cash flows vary significantly over time, providing a clearer picture of the potential returns. Next, the Adjusted Present Value, or APV. APV is particularly useful for valuing leveraged transactions, where the financing structure plays a significant role. It involves valuing the project as if it were all equity financed, and then adding the present value of the financing benefits, such as tax shields from interest payments. This method is particularly advantageous in scenarios where the project's debt structure significantly impacts its overall value. Lastly, the Profitability Index, or PI. The PI measures the ratio of the present value of future cash flows to the initial investment. A PI greater than 1 indicates that the project is expected to be profitable, while a PI less than 1 suggests otherwise. PI is particularly helpful when ranking and comparing projects with different investment scales. It allows investors to prioritize projects that offer the highest returns relative to their costs, making it an essential tool in capital budgeting. These specialized discounted cash flow techniques provide analysts and investors with a more comprehensive toolkit to evaluate investments under various scenarios. By incorporating these methods, financial professionals can make more informed decisions, ensuring that they choose the best possible investments for their portfolios.